What's up, everybody? Welcome to Heresy Financial. My name is Joseph Brown, and today we are looking at financial arbitrage. We're going to use a couple examples to explain what arbitrage is in a way that is really simple to understand. And then we'll look at that and look at why hedge funds participating in financial arbitrage at the scale that they're participating in puts the entire system at risk, which explains why the Federal Reserve is so keen on bailing them out through the repo market right now, keeping those repo rates really low. So we're going to dive into all of that and a little bit more. Thanks for tuning in. Let's dive in. All right, so in order to understand what the hedge funds are participating in, what arbitrage really is, we're going to use a really basic example, iPhones. You can see here, this is last year's model of the iPhone. And so arbitrage is basically buying and selling the exact same thing at the exact same time virtually for different prices. There are all sorts of arbitrage out there. You can do arbitrage with all sorts of different things. We're going to look at using an iPhone. What I can do is I can go online and I can check out what the price is for selling a used iPhone online. I can go to eBay, Craigslist, whatever I want. Let's say for this example, I could sell my current model of the iPhone for $600 online. I have no idea if that's accurate, but let's just say $600. Now, my buddy just upgraded to the new iPhone. And so he's got my exact same model just, kind of sitting on his desk. He's not really using it. He's not really sure that he wants to sell it right now, but he's not using it at the moment. So I'm going to go to him and I'm going to say, hey, let me borrow this from you for, just a couple of weeks. He says, sure. He's not using it right now, so he lets me borrow it. Now I have two of the same exact iPhone, right? So I'm going to take his, I'm going to wipe it, and I'm going to sell it online for $600. So what I just did there is called shorting. I sold something that I don't own. That wasn't mine. I didn't own it and sell it. I borrowed it and then sold it. So right now I have cash in my pocket of $600, but I also owe my buddy an iPhone, which right now is $600. But don't forget, I also have my own iPhone, and it was the same model that I borrowed from him. So my current position is net neutral, zero flat. I currently have $600 from the sale of the iPhone that I shorted, and I currently have an iPhone long. In investing, when you own something, you're long that position. So I'm short and long the exact same position. I've sold an iPhone and I own an iPhone. I have $600 cash, and I owe an iPhone as well to my buddy. So I am a net neutral flat position here. Now, what is my goal with this? Why did I enter into this transaction? Well, I did this because I expect, at least temporarily, the existing iPhones will be selling for a little bit less online. So I'm expecting, let's say in 2 weeks, that I'll be able to go back online and I will buy an iPhone online for, let's say, $550. And then at the end of the 2 weeks, now I'll have that iPhone back, and I bought it for $550, and my buddy's going to say, hey, give it back. He said, you borrowed it for long enough, I want it back. So I've already got the new iPhone that I bought from online, and I give it back to him. So I sold something for $600, and then I bought it back for $550. That's a short trade. So I sold something I didn't own, pocketed the cash, bought it back later for less, netted $50. I got to pocket virtually risk-free $50. My buddy, who I borrowed the phone from, he isn't any worse off because he wasn't using it at the time and he didn't want it. And as soon as he wanted it back, I was able to give it back to him. Now, what if it hadn't gone my way? What if, for some reason, let's say Tim Cook stepped down and he said, we're no longer producing iPhones. We're going to be, expanding, and we're going to focus all on teddy bears. We're not making electronics anymore. We're just going to focus on making teddy bears. Well, pretty quickly, I'm assuming that iPhones would become somewhat of a commodity. A lot of people would want iPhones. They might become rare. People looking at, long term, these are the last iPhones that were ever made. We're not going to ever have any new iPhones. So that price might have skyrocketed. Well, then my buddy would have come to me and he would have said, hey, prices of iPhones are skyrocketing. I might not be able to get one. You borrowed one from me, give it back. I want my iPhone back. Well, if I have to go to the market right now and buy an iPhone back, let's say buy an iPhone at like $1,000 or $1,500 to give it back, I lost a ton of money, right? Because I only made $600 when I sold his iPhone. So if I have to buy a new one on the market for $1,000, I just lost $400 because I had to spend $400 of my own dollars. But I have my own. So worst case scenario for me is I just give him my iPhone. I said, here, This is the exact same model, the exact same type of iPhone that I borrowed from you. All you got to do is wipe it, reload your own, from your iCloud backup or whatever it is. So worst case scenario, since I'm long and short the same position, I'm able to deliver on the short being closed out on me without me wanting it to, because I'm already long the same position. And my goal then is to capitalize on the difference between the one that I bought and the one that I sold, and the small price difference between the two. You see examples of arbitrage like this everywhere. There's even retail arbitrage where people go to garage sales. And if you're on social media at all, you've probably seen Gary Vee. He's pretty popular at this. He'll go to garage sales. He'll look for little, collections of stuffed animals or race cars or whatever it is. And then he'll buy them for a couple bucks, a big bucket of them. And he'll go online, see that some of them are collectibles and they're selling for, 30 or 40 bucks a piece. And then presumably he hires his secretary to go package them all up and send them all out and mail them as they get sold. So that's a form of retail arbitrage. You're basically buying something and selling the exact same thing, and you're pocketing the difference. Okay, so you get iPhones, you get garage sales. What are hedge funds doing, and how does this cause systemic risk from hedge funds participating in this? Hedge funds, specifically RV hedge funds, relative value hedge funds, they're doing arbitrage with currencies and bonds. Long-term capital management was the name of a hedge fund back in the late 90s that was doing this, and they were very successful at it until they blew up and almost took down the global financial system. But essentially, you're buying and selling virtually the exact same bond at different times or at the same time at slightly different prices, and you're just pocketing the difference. And worst case scenario, you own one and you owe one, and so worst case scenario, they're going to net out against each other. You've got a neutral position. And so RV hedge funds right now, they're kind of spins on that company, long-term capital management from the 90s. They do things a little bit differently, but essentially it's the same concept. They're long and short financial instruments like currencies and bonds based on their interest rates. And so they might be short something that pays a negative interest rate and long something that pays a positive interest rate, just basically sovereign bonds, sovereign debt from different currencies in different countries, especially ones that have currencies that are pegged to the dollar. And so you're engaging in this arbitrage where you have one position that you're short, another position that you're long, and they balance each other out because you owe one and you own one. Now let's go back to the iPhone example. The iPhone example was an example of a normal market if a bad thing happens. Well, I've got one that I can just deliver. But the unexpected is never really taken into account in these financial models. So one of the unexpected things that could happen is, let's say Apple, like in the first example, let's say Apple decided to stop making iPhones. And let's say at the exact same time, I dropped my iPhone and it broke. So I don't actually own the exact same thing that I owe. It's just very, very similar. And so the fact that it's just very, very similar and not the exact same thing means that there's risk for these unexpected events to happen. So if I go to my buddy and I try and give him back this broken iPhone, he's going to say, no, give me one back, the exact same thing that I loaned to you. So then I will have to go to the market and I'll have to buy one and deliver it to him. Same thing with these hedge funds. They have very similar things that they're long and short at the same time, but they're not exactly the same. So you do have small opportunities for events that move them in the opposite direction where they won't actually counterbalance each other. You won't be able to deliver one for the other. One might get more valuable while one gets less valuable. Now, if this happens in isolated examples or on a small scale, again, it's not the worst thing in the world. You might have a hedge fund or two that loses some money on a trade. But there are two problems with this. Number one, they're not doing this in isolation. There are a lot of hedge funds participating in virtually the exact same strategy. The second problem is the size of their plays, the size of their trades. They're absolutely enormous. Now, on a net basis, they're not enormous, right? Because if I do my iPhone trade and I'm pocketing $50, well, I'm net neutral on the trade, right? Because I own the same thing that I owe and I pocket $50. So my net position is a $50 position. And worst case scenario, it goes to a $500 position if I do actually have to go to the open market and buy one back and deliver that one instead of my own. But when you're measuring risk, you can't look at the net value. You have to look at what's called the gross notional value, especially with derivatives. The gross notional value takes into account the entire position of both sides of the play, regardless of whether they are expected to net out against each other or not. And so in my example, I'd be long a $600 iPhone and I'd be short a $600 iPhone. And so my open position at that time would be $1,200, not $50. And so while the net values of these hedge funds exposures to markets might be relatively small, the gross notional value is actually enormous. And part of the reason why they're able to create such large positions in being long and short currencies and bonds is due to leverage. They're extremely highly leveraged because they're engaging in virtually risk-free trades. And so banks are willing to offer them large, enormous sums of money at extremely low interest rates because the Federal Reserve is keeping interest rates so low to encourage lending. Banks have to make up in volume what they're lacking in the amount of the interest rate, so they have to loan more. And so if you can loan money out for a virtually risk-free trade, you're not giving it to an entrepreneur who might fail at his business or something. You're giving it to a hedge fund that is engaging in a trade that is virtually risk-free, at least on paper. You're going to do that. And so they're going to load up on these trades, and the net value of their books is going to stay relatively small. But the absolute size, the total size of their exposure to these markets is enormous. And again, in normal environments, that's not that big of an issue. But it becomes an issue when you have something not normal happen. Because what happens when one of these hedge funds gets strapped for cash? What are they going to have to do? They're going to have to close out part of their position, right? So one of the instruments that they're long, they'll sell, and one of the instruments that they're short, they'll buy back, right? So they'll close out their position. Well, if that trade is big enough to slightly move the prices of each a little bit, we already know that a lot of these hedge funds are engaged in the exact same behavior. So let's say there's a different hedge fund that's pretty close. They're on the line. They're toeing the edge. They're toeing the edge of the line pretty much as close as they can be. And that slight move, they're like, nah, I'm not comfortable with that. Now on paper, it looks like my position is at a little bit more of a loss than I want to hold. I want my position to look a little bit better. So I'm going to close out a little bit. Well, that's the exact same direction on buying and selling these virtually identical products that are virtually identical but not actually identical. You know, you've got your two iPhones. They're extremely similar, but not the exact same thing. And so you have this other hedge fund buy and then sell in order to close out their position, which creates an upward movement. You know, it creates supply and demand discrepancies that moves the price up and down on these two different areas. And so you can start to have a cascading effect. Now, before that happens, hedge funds are going to go to the repo market for cash because they don't really want to close out their assets. They don't want to close out their positions. They're just holding on to those because it's virtually risk-free money, right? So they're going to go to repo market for their overnight cash. They're going to offer something as collateral, get the cash with the agreement that they will repurchase that collateral back at a future date. That's why it's called the repo market. Repo is repurchase, and that will supply their cash needs. Well, let's say there's some liquidity crunches for some reason. Well, what's that going to do to the repo rate? That's going to make banks need a higher amount of interest in order to feel comfortable lending out their cash. Hedge funds need the cash, so they're going to pay the higher interest rate. But at a certain point, whether it's 5% or 10% or 15%, that interest rate on borrowing cash for a short period of time, that's just not worth it. So that hedge fund might decide to sell or close out part of their position. What happens if the collateral that hedge fund is offering to borrow in the repo market is not really that great of collateral? Let's say some of the banks are hearing some whispering that, that these book values are too big, that some of the debt that's being shorted or that is owned is not actually good debt. There's, maybe some emerging market debt in there. Whatever it is, let's say these banks are saying, you know what, 2%, 3%, I'm going to hold off until I might loan my cash out in the repo market at 5 or 6%. Well, again, you can have that cascading effect where the collateral that's being offered maybe doesn't look as good, and then the cash needs really start to hit. And then another hedge fund says, hey, well, if cash is drying up and liquidity is drying up, I need to get my hands on some cash right now so I don't have to close out my positions. So you can have a huge spike really quickly in the repo market. We've been seeing it come up a little bit again recently, the last 2 nights. It's been oversubscribed again. And so we're seeing these problems crop up again. It hasn't been squashed. But if the repo rate skyrockets again to a point where hedge funds still need cash and they can't access it through the repo market, they're going to have to close out their positions. And that's where you have this cascading effect, kind of cause like a domino effect in the market where they start to close out their positions, but by the very nature of them closing out their long and short positions, they're driving those prices of those financial instruments, those bonds and currencies, higher and lower. The ones that they're buying to close out their short and the ones that they're selling to close out their long. Well, that's going to drive, that selling pressure is going to drive those prices down and drive these prices up, which is going to make all of the other hedge funds have to start to do the same thing because all of a sudden they're showing all these huge losses on paper. So very quickly you can have a cascading effect where two instruments have virtually no differences. They're pretty much the same. But one of them, the price starts to fall drastically and quickly, and the other one, the price starts to rise drastically and quickly. And due to the size, the immense and sheer size of the gross notional values of these hedge funds books, it can topple markets extremely quickly. So that is one of the biggest reasons why the Federal Reserve is so keen on keeping rates low in the repo market right now, and why it looks like they're bailing out hedge funds, because essentially they are. The same story, new package. They're afraid of failure of financial institutions trickling over and causing a systemic failure in the overall financial system. Now, 10 years ago, there were some people blaming homeowners and saying, hey, you shouldn't have bought 6 or 7 houses when you worked as a waiter part-time. You shouldn't have used an adjustable rate mortgage. So you can blame the homeowners for creating all of the bad loans in the first place, for borrowing beyond their capacity. You could also blame the banks because they were engaging in extremely risky behavior, doing things that were, if not downright illegal, dishonest, making tons of money, knowing it was going to put the entire system at risk. You could also blame the policymakers for not seeing these things coming and not regulating and not making these things illegal. My beef is the fact that all the free money has been available all along in the first place. If there wasn't this implicit bailout, this government guarantee through things like FDIC, quantitative easing, the Federal Reserve expanding their balance sheet, acquiring assets for their balance sheet, if the support wasn't there and the government wasn't standing by ready to bail out failing institutions and buy bad assets whenever they come available, the risk taking, it would still happen, but it would be isolated, and the failure of that risk taking when it goes bad would result in consequences for the person or entity responsible for taking the risk. There would be skin in the game. So the failure of one would become a lesson for others to not engage in similar behavior. But the moral hazard that is caused by the lender of last resort producing and providing a constant available bailout for anybody that does any risky behavior, the only thing it does is cause more of that risky action and investing in the meantime, because you're making money from it. And if it all goes to hell, the Federal Reserve is going to bail you out. So that is financial arbitrage. I hope I explained it well. If you do have any questions or thoughts, please let me know in the comments section below if there was anything I said kind of didn't make sense there. But I really appreciate you tuning in. If you liked it, hit that like and subscribe button. You guys have a great day.